You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back. Episode 201, a very big milestone episode. First one after episode 200. Now that doesn't happen very often, does it?
No, usually stop at 200. We thought about it and then no, we didn't.
How you going, mate?
We're back here again. I'm doing well. How was FinFest? I'm very jealous. I wasn't able to go to this big Australian financial conference kind of thing over the weekend. How was it?
Yeah, it was great. Had a really good time. Met lots of people that follow both my YouTube channel, but also the Young Investors Podcast. So shout out to all the people that came up that recognized me from the Young Investors Podcast. It was good to talk to you. It was a really good event. Awesome. Bryce and Alec from Equity Mates, they did a great job in hosting it. And Stake, the guys from Stake were there. I think they were the major sponsor of the event. Right. So it's good to catch up with those guys as well. It was just really, really good. I was so busy talking to creators and you guys that I didn't actually attend any of the conference things by the speakers themselves. I actually, that's not true. I kind of attended. There was a main stage. There were two stages where you had to put the headphones on. It was like the silent disco kind of setup. And then there was a main stage. So I did attend a couple at the main stage, truth be told. It was good. It was good meeting all you guys, and if you're one of the creators that I met as well, it was really, really good to meet. We got a lot of Australian creators, a lot of short form creators as well, which is interesting. TikTok, Instagram. Yeah, how's your wedding though?
The wedding was great. All I was going to say is it's hard to remember, or it's hard to tell how many creators there really are until you kind of go to these events and you kind of see everyone come together, because we're all so isolated in a way with kind of what we do, and then these events kind of bring everyone together, and it's crazy how many people there are though. But yeah, the wedding was good. Yeah, it was good fun. So nice. I didn't have a boring weekend, that's for sure.
That's good.
We'll definitely have to. Hopefully I presume they'll probably do another one of those festivals next year, or conferences next year, I would presume.
I hope so.
Hopefully it went well enough that it gets another year. But yeah, it looked crazy how well they set it up. The main stages were very impressive. It was it wasn't like cheaply done or anything like that.
No. I was talking to Bryce and Alec. I won't get obviously into the details, but it seems like a very big challenge to put on an event. I think those guys have worked incredibly hard to pull it off. So big ups to them, because I think they did it. It was a really successful event. There was heaps of people there. So yeah, they did it. But yeah, hopefully we can do something. I had a quick chat to some of the Stake guys, and they said they'd be interested in potentially doing some sort of other event, potentially with us. But that was all just maybe. So we'll see if something comes of that. But yeah, it was good fun, really good fun. Hopefully they do it next year and we can all go along. But with that said, what are we talking about today, Hamish?
Yeah, what are you talking about? We've got some inflation data out of the US and the UK. I think you're going to take us through the UK, and I'll take us through the US. Yep. And it's earnings season. Earnings season is upon us. It really snuck up on us. I wasn't really expecting it, to be honest. It was like, it's already starting this week, and he always kicks off with the big the banks. I think were last week, but they're boring. No one cares about them. And then this week and next week and the week after that will be a lot of the businesses. I think that some of us will be interested in, tech related companies, the high flyers, and some of the high flyers that are not so high flyers anymore. Stumbling through 2022. So I'm going to talk about Netflix, which happened, which reported just this week, and a couple of other things around Netflix as well. It's been a big couple of weeks for Netflix, so a few things to talk about there.
Right.
What else have we got? Tesla.
I'll take us through Tesla. Yep, I'll take us through Tesla. Big quarter for Tesla. So very interesting data out of there. There's a lot of stuff to cover with Tesla. But I'm looking forward to it. It should be. I think it'll be a pretty jam-packed episode. I'm excited to hear about Netflix too. Always like talking Netflix. Anyway, should we get into it?
Yeah, today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically or you can, by connecting your broker, or you can download your trades using Excel or enter them in one by one, whatever you want to do. And once you do that, it will allow you to track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. Currency exchange has been a big one this year, especially the US dollar has gotten stronger against pretty much every other currency. So if you have shares in the US, then you have a net benefit from that and vice versa. So you want to make sure that you're tracking that, and it's really hard to do without using something like Sharesight, which is able to obviously grab the data in real time constantly. And then you can also use Sharesight for tax time. So Sharesight generates up to 12 different reports that can be used to track the performance of your portfolio, as well as use the tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan for as long as you want, or you can also use that link to sign up to a paid plan, and you'll get 4 months off a yearly subscription if you use that link. So go check it out. If you're interested. And thanks, as always, to everyone who uses that link and is supporting the podcast.
Yeah.
All right, where should we begin? Where should we... What do you want?
We want to leave inflation till later and do some earnings?
We can. Well, I can kick us off with Netflix, and
sure.
We'll probably take the entire episode as always. So I'll try and keep it. I tried so hard to just keep it to like the main points, but there actually is quite a lot that happened with Netflix. So I think it's important to talk about.
Yeah, definitely.
The first thing, before we even get to earnings, last week they launched their new ad-supported tier. So this was something that everyone was expecting from Netflix. They announced that they were going to be doing this about 6 months ago, but no one was really expecting them to get it out so quick. It's only been 6 months, and that's kind of insane that they've been able to go from not really even thinking about ads to getting an ad model out in 6 months. So kind of crazy. Some details on it. It's going to sit below the 3 existing tiers. So they're not putting ads on any of the current plans. They're still having the basic, standard, and premium. And then they basically have a basic with ads, which is the same as the basic plan with ads.
Basic.
Basic. How many times can I say basic in one sentence? Instead of $10, it'll be $7, and then there will be some advertisements played. So that's kind of what they released, and they gave us some information around where it'll be operating and that sort of thing. So they're launching in 12 countries starting in November. Australia, Brazil, Canada, France, Germany, Italy, Japan, Korea, Mexico, Spain, the UK, and the US. And those markets actually account for more than half of their revenue. So they're launching in a massive way, very, very quickly, which is not something that, again, most people expected. I think, as I said, probably a few months ago, I expected them to launch in Australia because we're usually like a test market, and we have a developed ad market. And they were definitely going to launch in the US and the UK. But yeah, they're launching across quite a wide spectrum of different countries, and across those different countries there's obviously different pricing points and that sort of thing. So interesting to see them get it up so quickly.
Yeah, and I think it must be something to do with their collaboration with Microsoft, being able to do it so quickly. I'm just looking, because I couldn't remember, but yeah, Microsoft is powering Netflix ad-supported tier.
Yep.
That was announced in July, I think. Netflix named Microsoft as the exclusive technology and sales partner to help power their first ad-supported tier. Since then, teams from Microsoft and Netflix have been working hard to make this new tier. Okay, they celebrate the announcement. Yeah, blah, 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 blah. Yeah, there you go. I don't quite know how that all works, but I would imagine that's the reason why they're able to do it so quickly, is because they've got the flipping muscle of Microsoft to come in and be like, don't worry, guys, this is what you need to do. We'll do it. We've done it. Here you go.
Yeah, so Microsoft already has significant, obviously, tech infrastructure teams and also ad sales teams. So they were able to kind of integrate those very quickly. And Netflix is building out an internal ad team as well.
Right.
But yeah, being able to partner with Microsoft allowed them to just get it up really, really quickly. And that was, what did you say, July? So that was news from kind of a few months ago.
That's fast.
And they've just a couple of months ago now they're rolling it out. They gave us a lot of detail in terms of how many ads and that sort of thing. So they're going to be doing 4 to 5 minutes of ads per hour, which is a pretty light load. For if you think about television ads, it's more like 15 minutes of ads. So it's quite a light load just to start off with, which is what you would expect. 15 to 30 second mid-roll ads as well as pre-roll ads, pretty standard stuff. Nothing too crazy. On the conference call at the earnings, they gave a little bit more detail about this. They expect to be the unit economics of this plan to be neutral to slightly positive compared to the basic plan. So they essentially think that they'll be able to recover the difference in the price with ads, and then maybe a little bit more to cover the additional cost that comes with doing ad sales and that sort of thing. Obviously, there is some additional
bit
cost.
of overhead. Yeah.
Exactly. But then on top of that, so they think they'll be about neutral. They're not expecting to kind of it to be much better or much worse than their existing plans in terms of revenue. But they do expect, of course, to be able to drive higher revenues through capturing new subscribers. So that's something interesting to hear, because a lot of people were worried that there would be a lot of cannibalization, that people would unsubscribe from basic or from standard or premium or something and then subscribe to the ad version, and that it would hurt their business. From what they're looking at, they believe that they'll be about neutral.
So it shouldn't matter.
Even if people switch. Yeah, exactly right. And they spoke, go on.
I was going to say something completely different. I wonder how this will, once it starts getting rolled out, how it will be received, because I think there's two kind of ad environments. There's the television ad environment where you know that you're going to watch X amount of minutes of a show, and then you're going to watch a couple of minutes worth of ads. You know, people stand up, they walk out of their lounge room, they might go get a snack, go to the bathroom, come back, and by the time they come back, the ads are over, they're ready to go. Do people that want a cost-effective way to get into Netflix see it like that, or is there so much, laptop, desktop, mobile watchers of Netflix that they see it more like a skippable environment? Because I think when you get to desktop, mobile, and desktop, laptop, mobile, the ad structure is very much more of a skippable. Like you watch a certain amount and then you're able to skip. And even on sites like Amazon Prime Video, even their ads, you can skip them. You can just go with your remote, boop, skip. So I wonder how it's going to be received. Are people going to have the expectation of it being like a TV ad and sit through them? Or are they going to get really, really annoyed? Because how annoying is it when you watch a YouTube video and you cop a 15-second unskippable? It makes you rage. It makes you rage.
It is funny that kind of different environment. I mean, the vast majority of people watch Netflix on a television. So for most people, the experience will be similar to television. But yeah, you're right. It is kind of a different expectation when you're on a computer. You want something to do because you're right. Like you can, the standard thing is to get up and do something else. Maybe you check your phone. Maybe you check your phone even. But if you're watching on your phone, you can't check your phone while the ad's playing. So it is interesting. But it is kind of it also speaks to likely the more effectiveness of the ads and the higher price they can charge than television ads, because people are more likely to be watching the ads rather than television, where you get these massive slabs of 3-minute ad blocks and people actually do get up and leave. Whereas if it's 15-second, 30-second skip, like not skippable, 15-second, 30-second ad, you're probably just going to sit there and watch the ad and then it resumes programming. So it'll be interesting to see how it plays out.
Maybe they're more effective ads, so they have to run less of them to generate the same amount of revenue. Maybe that's how it works out. Who knows? Anyway.
Yeah, and we don't know. Someone asked that question. How much are they on the conference call? How much are they charging for ads? They didn't answer the question. There was a leak a little while ago that they were charging a $65 CPM, which is insanely high. So
it's high.
We don't know if that's true. But if they're able to get that, then it makes perfect sense why they're able to run far less ads under this model. So
I don't think they can charge that. That's insane.
it seems insane, right?
Yeah.
I don't think they can either.
No.
And it was interesting because they also spoke about how they were selling ads. So basically, just to get it up really quickly, they just sold a block of inventory of ads at a set price. And then after that, they'll go into a typical bidding system, which is what how most advertisers pay for ads. They kind of bid and compete based on the demand for particular ad placements. But just to get it up really quickly, I don't know how long they sold blocks of inventory for, probably 3-6 months, maybe a bit longer. They just sold it at a fixed price. So I guess it's possible that they sold at a really high CPM, but then later on, it might kind of go down over time. So, so yeah, that was last week. And then this week they reported their earnings, and the markets were very happy about earnings. But it was kind of a mixed bag. I wouldn't say it was overly optimistic. It was kind of just it was better than expected, I think. And the expectations for Netflix were rock bottom. So it would have been hard for them not to have hit. I mean, they only projected forward 1 million subscriber ads, and that's after losing 1 million the quarter before. So they were just expecting to kind of hum along. They ended up adding 2.4 million subscribers, and total revenue came in at 7.9 billion for the quarter, up 5.9% year over year. So revenue growth is very, very slow. And one of the big reasons for that is foreign exchange. I think we've kind of spoken about this a little bit recently, how the strengthening US dollar is really bad, at least in the short term, for businesses that collect revenue in foreign currencies and then have expenses in US dollars, because those expenses stay the same, but they collect less currency dollars when they collect less US dollars when they do the conversion, right? Yep. So that's been Netflix's story. If you exclude the FX impact, revenue was up 13%.
Oh, wow, so that's big.
The growth was slapped in half, basically, even a little bit more by the strengthening US dollar. So yeah, it really does show you how dramatically the US dollar has gotten stronger recently.
And it's not something like in the long term, generally these things even out, but this is just something where it can have a sizable impact in the short term. Yeah. So it's not necessarily an issue or a worry or something you're like, oh, this changes my investment thesis. But yeah, in the short term, it can play havoc with short-term profitability stats, revenue stats, etc. Yeah.
Yeah, it's just one of those unknowable things. I mean, who could have known that the US was going to be the most aggressive first at interest rate increases, which is really the whole dollar strength story.
Yeah.
Who knows what comes next? Maybe the UK is very aggressive next, and then the balance between those two shifts, and they're collecting more. They're collecting more from their UK customers then, or maybe it's Australia's increasing. So whatever it is, wherever the rate hikes come from or rate lowerings, will just affect that over time. So there's that.
There you go.
They spoke about engagement, which is something Netflix always focuses on. How much time are people spending consuming Netflix? And really good news for investors is they now have engagement data from the UK. So up until now, they've only had US data from Nielsen, which tracks TV usage in the US. Now there's a company called Barb. Well, this company's been around for a while, but Netflix is now a part of it. Broadcasters Audience Research Board, which now takes a look at streaming engagement in the UK. Very similar to Nielsen in the US. And Netflix, as of September, had 8.2% share of viewing. And the next closest was Amazon Prime at 3.6%, which is very, very similar to the US. Pretty much the percentages were almost identical to the US. So it shows that the way people view streaming content in the UK is very similar to the US, which I guess shouldn't be too surprising. But still interesting to see. And then just the last thing, just on their content, 2 of the shows that they released this quarter were the 2 of Netflix's biggest shows of all time, which is kind of crazy, right?
Wow.
Jeffrey Dahmer. I don't know if you've seen that. I think it's called Monster Jeffrey Dahmer or something. About a serial killer in the 80s. Right. Great show. I haven't actually finished it, but I've watched a few episodes. It's quite good. 824 million hours watched. It's the second highest in Netflix's history. And number 1, of course, was Stranger Things 4, 1.35 billion hours watched. Best of all time. So, yeah, I mean,
that's insane.
Can't really complain about their content. I mean, they've had their 2 biggest shows in the last quarter. That's pretty much as good as it gets. So, yeah, it's been interesting to kind of see that. But
they've done very, very well at creating it's almost viral, like viral video, but it's viral TV shows. Thinking, what are some of like the Tiger King one? That was Netflix, wasn't it?
Like Squid Game.
They just have the knack
Queen's
of
Gambit.
Yeah, they have the knack, whereas some other streaming services just don't quite have that same capability of creating that ultra mega viral TV show.
Yeah, it's actually funny you mentioned that because the management team spoke about that specifically and why they think that is. And they think it's because of their binge model. So they posted like a Google Trends chart and showed the Google Trends for House of Dragon, Lord of the Rings, which both come out weekly, and then compared that to Jeffrey Dahmer. And House of Dragon has a much more prolonged viewing experience. It kind of has little peaks every week as the new episodes come out. But the Jeffrey Dahmer was the highest peak was like 3 times. So the search volume, as soon as it comes out, when everyone is able to binge the whole series, is kind of explosive. And it was just basically Netflix saying, we're going to continue to do this, although they are definitely testing some week by week and that sort of thing as well. But it is interesting. I feel like my opinion on it is that it depends on the show. I feel like for something like House of Dragon, where there's probably a lot of fan theories and discussions, I think week by week makes sense. But for something like Jeffrey Dahmer, where it's a true story, and there's not really any theories you would come up with on a week by week episode, it's kind of just, oh my God, go watch this. It's crazy. It's insane what this guy did. It kind of makes sense in that case. There's not really any spoilers or anything like that, if that makes sense. So I feel like different shows could have different models for release.
Yeah, especially with that show like the Jeffrey Dahmer. It's like if you just stopped after episode 1, people would be like, oh, I wonder what happened. What happened to this guy? You know, I'm getting so into it, and then they just look it up. Like they wouldn't have to wait.
Yeah, that's so true. Yeah. But I find like, especially with those true story, like the murder ones and that sort of thing, no one really spoils it for anybody. They kind of just, you can't really spoil it. You know he's going to kill a bunch of people. Like you can't really spoil it. Whereas like House of Dragon, Rings of Power, I get it. Like people want to come up with fan theories and discuss with their friends, and they don't want someone to be finished and someone's halfway through the season. So that makes sense to me. But we'll see how the space evolves over time. Yeah. I don't have. I'm recording my audio behind me, so I can't see how long we've been going for, and I don't know how long I just spoke for.
We are at the 22-minute mark. We're at the 22-minute mark. Bad. Nah, okay, it's not too bad.
I'm sorry. I'll shut up now.
We probably started Netflix. You only probably been speaking for like 12, 13 minutes. It's not too bad at all.
Okay.
Not too bad.
That's not bad.
Is that all we've got for Netflix this time around? You got a little bit more?
That's it. I mean, I've got more, but I'll
all right. But to access that information, you need to join Hamish's private community.
Yeah, exactly.
Exactly. Should we talk about Tesla?
Yeah. What's been going on with Tesla?
All right, I got to time myself now. You've had your Netflix. Now it's over to me for the Tesla section.
Yeah, the remaining 35 minutes.
Yeah, exactly. I love Tesla so much. People always think I'm I am a Tesla fanboy. I wear all like the merch and I've got the car and stuff. Everybody's always like, oh, but I thought you were a value investor. It's like, I'm just a fan of the flipping company, for Christ's sake. I do hold Tesla stock in all honesty, but I did buy it back in 2017 and I haven't bought much of it since. Anyway, so last week we saw record deliveries, 343,000. So that was exciting. But now we can add record revenue, record operating profit, and record free cash flow to the mix, which is interesting.
Wow.
And worth noting, this is a time where costs are rising. Well, at least in Q3, costs were definitely rising. And I've just written like, forget about the valuation. We're not talking about buying and selling stocks. I just think that this is a really interesting business example of a company that is still able to grow in a period of economic weakness. Like how many companies have been pulling back, been struggling now that the market's tanked and rates are rising. But this is a really interesting example of a company that hasn't been affected by financially they really haven't been that affected. They've been able to continue growing and growing and growing and pushing record result after record result despite what's happening in the economy. So anyway, I thought it's interesting. Let me take you through it. So as I said, 343,800 deliveries for Q3, up 42% year over year.
It's a bit of growth.
Solar deployed 94 megawatts, which is up 14% year over year. Then battery storage, 2,100 megawatt hours, up 62% year over year. So a lot more battery storage, a lot more power walls, mega packs, that kind of thing. Store and service locations up 16% year over year, and superchargers up 33% year over year. So that's the first place I like to start with Tesla. It's all operational. I like to see, how they're going and growing the various aspects of their business. Obviously, the automotive, just car production deliveries is the most important, but still, they have a pretty decent sized energy business.
Yeah.
From there, their financials, so their automotive revenue was $18.7 billion, up 55% year over year. So total revenue, so $18.7 billion was automotive. Total revenue was $21.4 billion. So you can see it's mostly car sales.
Auto still.
Total revenue was also up 56% year over year. Right. Automotive gross margin was 27.9%. Okay, which is slightly down year over year. It was 30.5% a year ago. But if you have a look at this, their operating expenses have grown just 2% year over year. Okay.
Wow.
And thus their operating margin, Tesla's operating margin, is now at 17.2% versus 14.6% in Q3 last year. And this is for a company that's primary business right now is just selling cars. So sorry.
No. I was going to say, it perfectly makes sense that you would see gross margin decline, cost of materials, cost of delivery and shipping. All of those things have been getting, just for any business, have been getting more expensive. So that makes perfect sense. But yeah, their ability to, as they've scaled, I guess, have some significant efficiencies on, you'd expect efficiencies on both their gross margin and operating. But yeah, even through an inflationary period, to have that kind of have that scale efficiencies, unit economics is really interesting.
Yeah, 100%. Really so, for context, this operating margin, 17.2% for Tesla. That's higher than the S&P 500 Q2 average operating margin of about 15%. Wow. And it absolutely obliterates the auto industry average operating margin of about 8%. So
yeah, that's insane.
Very, very impressive. I mean, this is essentially, I know, don't at me. I know in the future, they're working on so many things, but right now, if you didn't look at anything else and just what their business looks like right at this very moment and where they make their money, Tesla is an auto company. That's how they make their money. They sell cars. They build and sell cars, and that's how they make their money. I know full self-driving, blah, 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 all in the future.
Yeah.
You just look there. So for right now, a company that sells cars to have a operating margin up at 17.2%, I think is quite impressive, actually.
And even to go a step further than that, if you looked at the economics of other electric automakers who are doing that at scale, most of them are unprofitable at an operating margin. So that even speaks more volume, because it is a different way of producing cars. There's different systems involved. So the fact that they're beating the whole auto industry is insane. And then they're clearly destroying anyone who's even close to, if they're a pure electric automaker.
That's actually a really good point. I didn't even think about that, but that's a very good point. Okay, so overall operating income came in at $3.7 billion, up 84% year over year. GAAP net income was $3.3 billion. Capital expenditures came in pretty standard. Sorry, what were you going to say?
All I was going to say is just crazy how with their operating expenses not going up, 50% on the top line, 84% on the operating income is that just shows you just the insane difference just from the becoming more efficient. It's impressive. It's crazy.
It is impressive. What was I talking about? CapEx came in pretty standard, $1.8 billion for the quarter, but the stronger cash flow from operating activities, which was $5.1 billion, gave them a record of $3.297 billion free cash flow, and they increased the cash on their books by about $2 billion. So they're now up to $21.1 billion of cash. But this is the thing, right? So Tesla's market cap's now $696 billion. They just made $3.3 billion in the quarter of free cash flow. Annualized, that's $13.2 billion in free cash flow. Price to free cash flow of 52. So bit exy. But if you just take a step away from that, year to date, the stock is down 44.5%. And on the conference call, Elon spoke about how he and the board are now trying to buy back Tesla stock.
Why?
Interesting. On the conference call himself, Elon said both he and the board thinks it makes sense. He said it's possible for them to do a $5 to $10 billion buyback, even if next year is very difficult economically. And it's likely that they'll do some meaningful buyback then. So, I mean, traditionally you look at that and you're like, whoa, you just burning your money. But I'm kind of torn because I also think like Elon's not stupid. The Tesla board are not stupid. They are very careful what they spend their money on. So they must really, really back themselves over the next 5 to 10 years. They must be like, okay, sure, if you just look at our data now and we do a buyback, this looks silly. But we genuinely believe in 5 years, in 10 years, we will be here, our business will be here, our stock will be here, and therefore if we can buy back shares now after they've dropped 44% or whatever I said, 44.5% in 2022, then we'll still be coming up on top. I don't know.
Yeah, I don't know.
That's weird.
What's your thought?
Give me your honest thoughts on that.
Well, my honest thoughts on that is when you have a company, $3.3 billion in free cash flow, they have $20 billion in cash on their books. If they can get a decent amount, if they could invest that in the business and get a 15 or so % return, they can significantly increase that $3.3 billion just immediately if they had a way of deploying the $20 billion. Now, maybe it's obviously an industry that's very capital intensive, so it could be a very difficult environment to do some of the expansion that maybe Elon plans to do over the next 5 years. Maybe it's not the next couple of years are going to be much more expensive to do it or much more difficult to do it. So, obviously I don't understand the auto industry. So it could just be the case that, right now the best use of cash is in their stock, especially if he does think that the earnings can appreciate significantly. But yeah, I don't know the value of the business. I'd have to, if I had an insight into the value of the business, I'd have a better idea of if this is insane or not. But yeah, I don't know.
It's interesting on that topic of putting that money back into the business to grow. He actually did comment on that, which I found interesting. He said that Tesla are pretty much maxed out at how quickly they can spend money and grow effectively. And he said that the primary constraint for that was with the labor market conditions, they actually can't get enough engineers to do what they need to take that next step.
Yeah.
And that's what Elon, he went on a bit of a rant on the earnings call. He was saying like, people think that like we can just grow and grow and grow and the engineers just like, you can just pluck them off trees and just be like, can you build this factory? But he's like, it's really hard to find really good engineers that can do what Tesla needs them to do to grow. So I thought that was very interesting. I hadn't really thought about that, but it definitely put things in perspective.
We spoke about that last week as well. I mean, the labor market in the US is as tight as it's ever been. I think it was the lowest since December 2019, and before that it was the lowest since 1968 or 69 or something like that. So even if there's not enough people, there's no people for them to hire. So that actually makes perfect sense into why they would look for other uses of the cash, because labor conditions are not going to be this tight forever. That's just not how economics works. So that means that there'll be points in the future where it'll be easier for them to get those engineers and then scale. So that makes sense. And look, that's the case with most businesses. That's why most businesses pay dividends, even growing businesses, or do share repurchases. They produce more cash than they can physically deploy. And obviously some businesses are very good at deploying it and others are not, but there is physical limits to how quickly, some businesses can expand. So if they think buying back the stock makes sense, I'd probably take a dividend and put it somewhere else, but no, I don't know. I don't know the valuation of
that's
Tesla,
fair.
so I shouldn't
It's very hard to make a call unless you have a strong sense of what they're going to be like in the future. Yeah. And that's the thing with Tesla. This is why there's so much argument over the valuation of Tesla, is that people come to different conclusions on what the future will look like for Tesla.
Yes.
That's 100% of why people argue with each other over Tesla stock. If you believe in Elon and everything he says he's going to do, I'd agree. Looks cheap. If you think that they're going to hit some hurdles, or maybe, the Tesla robot's just this silly old thing that'll never do anything, you think that full self-driving is going to take another 20 years or whatever, then you're right. You'd probably short the hell out of Tesla stock. It's just like where you fit on that spectrum of future growth kind of dictates what you think about the current valuation. So there you go.
Yeah, I mean, it's obviously there's almost any valuation. Okay, not any valuation, but at the current valuation, of course, there is still a circumstance where it could be an incredible investment. I think the question is, what's the likelihood of that happening and that sort of thing. But it's obviously, it's not like if you bought the stock today, you have 100% chance that they don't ever live up to the expectations. Like, of course, there's room given what they're trying to do with AI and autonomous driving. These are industries that are massively changing, and
hard to model.
It's hard to impossible. I'd put it in that basket.
Fair enough. Anyway, I'll just get onto just a couple of notes that I took out of the earnings call. Elon was very optimistic for Q4. He was like genuinely excited. He kind of had to restrain himself for saying something he shouldn't say, but he is very optimistic for Q4, so we'll see what happens there. Berlin's up to a couple of thousand cars a week. Austin will be there very soon. If you extrapolate the production number from yesterday, it would equal 2,000 per week, but they're not there consistently. 4680 battery cell production tripled in Q3, which is a good sign. I don't think that's a mega achievement because I think they're still dealing in low volumes. So obviously it's easier to triple a low volume.
Yeah. They're making 3 of them now or something.
Sorry? Yeah, they're making 3.
From 1 to 3.
Yeah, went from 1 to 3.
Rivian exactly. And gone from 1,000 cars to 3,000. Yeah. We've grown 300%.
300%. Yeah, get around our stock, guys. Yeah, exactly. In terms of demand, people have been spitting out that kind of demand. Is there enough demand for all this stuff? Like, that's been coming up in the media lately. So Elon said he can't emphasize enough how strong the demand is for Q4. He expects to sell every car that Tesla can make for the foreseeable future. So there you go.
That's So just on that point, that's really good news because I wasn't going to talk about this today, but Winnebago reported, or at least I'm not sure if they reported or they just did a press announcement. But they're an RV manufacturer. It's basically an automaker, a bit more expensive than Tesla's, I think. So they're mostly more purchased on financing, but their dealer inventories, not their dealer inventories, their backlog has been dropping like a rock. It dropped by like 60%.
Right.
So they're not getting a lot of reorders, and that's heavily impacted by the fact that interest rates are so much more expensive. So it's much more expensive to get these vehicles. But that's typical of the broader auto industry as well. When interest rates go up, because a lot of people finance vehicles on loans, it's typical to see a significant drop off in demand. So that again just feeds into the strength of demand for Tesla, that they're not at least yet experiencing that. So,
Yep. That's interesting, actually. I wonder if when does Thor release their numbers?
Yeah, Thor has weird quarters.
Oh, okay.
So they're a little while away, but it will be interesting to see.
Yeah.
Most of the RV kind of manufacturers move in a similar. They kind of move together, and Thor represents so many brands that they pretty much move with the industry. So I would expect that they're also experiencing a big drop off in demand. I'm not sure about other automakers. I don't keep up with other automakers, but I would expect they're probably going to feel a similar pinch.
Interesting. Back on Tesla, we got a couple. I'll just fly through this. In terms of batteries, they're trying hard to produce 1,000 gigawatt hours per year in the US, all vertically integrated, so that's not including suppliers. I thought that was interesting. They didn't comment on where they are along that line at the moment. Cybertruck, early production mid next year. He said the car is going to be sick and it's going to be a Hall of Famer. And he also said, sorry, it's taken so long. And he blamed the global supply chain for that.
It's going to be weird seeing that car. It's going to be weird seeing that car on the road.
Bloody bonkers. Yeah, I know. I'm excited though. It'll be weird. It'll be weird, but wonderful.
Surely your car is just gone if you're head on with that.
I reckon so. I reckon you're in real trouble.
I'm gonna have to get one just to prevent that from happening. Just so it's
exactly. Yeah. The only way to combat a Cybertruck is with a Cybertruck. In terms of the Semi, first production units to Pepsi in December. Then the ramp will begin. They noted that it's 500 miles of range on level ground, fully loaded. So it's a long-range truck. They expect just other tidbits. This is just random tidbits. Stationary storage business to grow between 150 to 200% per year. So that's interesting.
Right.
Now, there's two more things I wanted to talk about. Elon was so optimistic. He spoke a little bit about how he's just super focused on the long term. And I think this is maybe going back to the whole buyback kind of thesis as well. He actually said on the conference calls that there was a time where he said that he could see Tesla being a bigger market cap than Apple. And then at some point, they're not there anymore because of market conditions. But at some point, they actually got there. They were ahead of Apple in market cap. And now he says that there is a potential path for Tesla to now be worth more, or in the future, be worth more than Apple and Saudi Aramco combined.
Wow.
His actual quote was...
What is that, like 4 trillion or something like that?
Yeah. That would be about, I think, 4 trillion or maybe more. Maybe Saudi Aramco is more than that. I don't know. It's the biggest company in the world, Aramco, I think.
Is it?
Then
it would be.
I think so.
Then it would be probably 5 or 6 trillion that he's for the combined, I would imagine.
I'm not sure. I need to check. Anyway, he says, quote, "For the first time, I see a way for Tesla to be twice the value of Saudi Aramco, and this is the first time I've seen that potential." So there you go. Right. I don't know. Of course, the haters will be like, "Oh, he's pumping the stock," but I tend to back him. I mean. He did asterisk at saying this will require exceptional execution, really innovative products, and for those products to be well aligned, for the economy to not be shit, like all this sort of stuff. But and he didn't give a time frame, obviously, but he sees a roadmap, which I think was interesting.
Well, I mean, given how operating margins, the demand, all of these things for Tesla are going so much better than the industry average at the moment, given the environment. That doesn't surprise me that he's bullish. I mean, I'm sure going into this year, he was probably a little concerned about, because you never really know how your business is gonna go through this crisis. But given they're doing so well, at least right now, that just speaks to the core demand for their products, which is ultimately the biggest what matters the most. So.
Yeah, definitely. And then the very last thing I promise, that this is particularly interesting for what we're about to talk about, is that Elon. So Elon's an interesting guy because he's got his he's got his hand in many industries. He's very in line with manufacturing. That's essentially, he calls himself like a technologist, manufacturing guy. So he likes manufacturing. Yep. You need stuff to be able to manufacture stuff. And he actually thinks that the Fed is raising rates more than they should, but he expects that they will bring them back down relatively soon.
Interesting.
Weird. And he actually said he's seeing more deflation as opposed to inflation in most areas.
That's really interesting. That's interesting to hear.
That is interesting to hear.
Yeah. I definitely, if his statement was the Fed will raise interest rates too high and then lower them, I would absolutely agree with that. I think I don't think there's ever been a time in history where the Fed has, they're always messy on both sides. They always do too little, and then inflation roars or whatever it is, and they raise interest rates, they get inflation under control, but then they go too hard with interest rates, so they cause a recession, and then they go back. There's never come what Ray Dalio calls like a perfect landing. So yeah, I don't think we should be expecting the US to avoid a recession. I think that would be pretty likely. In terms of whether they've done too much now, I don't know. But yeah, you're right. He would definitely have much more of an insight into at the manufacturing level at least.
Thought it was an interesting tidbit. He actually agrees with Cathie Wood, what she's been saying about how she thinks there's going to be like big deflation and stuff. So we shall see. But anyway, I thought I would put that in there because he does have insight into these areas. So interesting. Yeah. But with that said, let's talk about inflation a little bit. Start with the US, Hamish. What this is for September, right?
It's not deflation. I'll tell you that much.
All right, scrap that. Forget I said anything, guys.
We're not there. We're not there yet. Inflation in September continued to be.
This is rear view mirror still. So
correct.
September.
Yes,
we're in October, so we're looking backwards.
Yeah. Exactly. We're looking at September. Month over month increase for overall inflation was 0.4% month over month compared to 0.1% last month.
Damn.
So an increase, but in the scheme of monthly increases over the last 12 months, I think it's the third or fourth lowest. So
really,
it's not. Yeah, there was a number of 0.8s to 1% monthly increases. So
oof.
it's on the it's coming down, but yeah, 0.4 is still very high. Annually, it was 8.2%, and the annual inflation rate has declined for the third month in a row. The annual figure has declined for the third month in a row. So it's continued to kind of trend down a little bit, down from the 9.1% peak in June. So that's positive news. Unfortunately, I've got some negative news to balance it. Wouldn't be fair just to to be all positive. However, if you take out energy and food, which are kind of the volatile components of inflation, and look at core inflation, it's not looking too good. It rose for the second month in a row, 0.6% month over month increase, 6.6% annually. So core inflation is accelerating while overall inflation is slowing down. So yeah, energy and food are coming off, but core inflation is starting to pick up, and the two are actually like converging. If you look at the chart, energy made overall inflation go up really high compared to core, and now they're kind of meeting in the middle.
Yeah, energy's going down. Yeah,
and that core figure is the highest since 1982. So core's still pretty considerably high. What's driving inflation? It's always fun to look at on a monthly basis what's causing the biggest increases, decreases. Energy continued to decline, which was down negative 2.1% for the month over month. So that's a big decline again, same as last month. Mostly driven by declines in oil and gasoline. Unfortunately, for that small amount of good news, apparently early reports are showing that energy costs are rising again in October. So that looks like it might be not trending downward anymore. Food increased 0.8% for the month, which is still massive, 11.2% year over year. Shelter was up 0.7% and transport was up 1.9%. Those were some of the big increases. So yeah, inflation's it's still pretty high. I would imagine the Fed is still looking at doing continued interest rate increases, given that. But look, things can change so quickly. We can't get into this. Well, it doesn't really matter. We're just observing these numbers. But don't forget how quickly inflation took off. It can go down and maybe even to deflation that quickly as well. We really don't know what's going to happen. We're just, as you said, we're looking at backwards numbers month over month, and we could be looking 6 months out at much worse inflation, similar, or deflation. So we really don't know what's going to happen. Interestingly, the UN came out and took a stance this week against the Fed. They made a statement saying that no more interest rate hikes. Stop
back
it,
in Elon.
Yeah, they said stop it. Stop doing it.
We heard that Elon Musk said that you need to...
Yeah, apparently they've got a big position in ARK or something, I guess. So it's like the UN has to publish a portfolio or some rubbish like that, and it's just Tesla.
Just like mega corruption. Oh my God. The UN's just like a major shareholder in Tesla and ARK Invest.
Yeah. Oh man.
My God.
No, so that they came out and they really gave. There's really two narratives. We've kind of spoken a lot about the classic Ray Dalio view of what's happening, which is that a lot of stimulus on the demand side plus some supply issues have caused what's happening, and interest rate increases will reduce inflation. This is the alternative view. That's still a very popular view that we haven't really spoken too much about. But it shouldn't be. I mean, the UN. This is UN's position, so it's it's a significant position. They have a different view. So their evidence suggests that inflation did not come from loose fiscal policy or wage pressures, which are two kind of factors that the Fed believes are driving inflation as well as the supply issues. But they said, and this is the quote, but instead derives largely from cost increases, particularly from energy, and sluggish supply response due to a prolonged history of weak investment growth. In an interview on the report, Richard Wright, the head of the UNCTAD team, which prepared it, said this: do you try to solve a supply-side problem with a demand-side solution? We think this is a very dangerous approach. In other words, the policies being directed by the Fed are not the product of a misdiagnosis of the economic situation.
I think it's more supply side. Like, just you got to focus more on supply. Don't squeeze the demand side, but just do whatever you can to increase supply.
Yeah, and one of the big things that the UN looks at is how different central banks' policies affect particularly lower income regions and how that's kind of rippling out across the world, because it does have a big impact. We spoke about Netflix and how much of the impact FX has had on Netflix, but just think about, all of the other regions that are and they're not a multi-billion-dollar corporation like Netflix. Seeing the world currency, US dollar, get so much stronger against their local currencies does have a real impact. So that was also in the report about how it's having not only is it the wrong way to combat inflation, but it's having an outsized impact on these other regions around the world. So that was an interesting kind of take. We've spoken a little bit about the supply issues, but certainly like Ray Dalio thinks it's a combination of supply and demand. And we spoke about how, yes, it is in energy, but inflation is now across the board. So potentially higher interest rates could help alleviate pressure on those areas. But yeah, interesting to kind of hear their perspective.
There you go. That is interesting. So US inflation not looking good. Do you want me to talk about UK inflation?
Yeah. Is it better? Is it any better?
No. Unfortunately not. So this is just from an article that I was reading on CNBC, I think. The annual rise in the consumer price index hit 10.1% in September, according to estimates published Wednesday by the Office for National Statistics, just exceeding a consensus forecast among economicists, polled by Reuters. So people were remember last month, people were like a little bit excited because it dipped to 9.9%, but nope, we're back up. Anyway, the rate rose in the year to September 2022 as the country's cost of living crisis continues to hammer households and businesses ahead of a tough winter. Increasing food, transport, and energy prices were the biggest contributing factors to inflation. The ONS said food was up 14.6% year on year. Transport was up 10.9% compared to last year. The price of furniture and household goods rose 10.8%, but it doesn't say their energy price. Anyway, there you go. Thanks article. You done me dirty. The inflation data comes just as the bank plans to sell some of its government bonds, known as gilts, from November the 1st. Britain's finance minister, Jeremy Hunt, said in a statement that, quote, help for the most vulnerable will be a priority as the UK weathers high inflation rates, along with delivering wider economic stability and driving long-term growth that will help everyone. That sounds nice.
That sounds lovely.
Give me a bit of that long-term growth that will help everyone. I'm all for that. Jeez, he's a people pleaser. This Jeremy Hunt guy, love him. But yeah.
So there you go. Yeah. So yeah, they're in a bit of a tougher position than the US. Yeah. It looks like they're probably going to have to be a bit more aggressive on the interest rate increases, and that unfortunately is going to cause more short-term pain than some other places. So
yeah. What else does it say? On Monday, I don't want to go too deep into this. This is just pretty much the same story. On Monday, the new British finance minister, which is this Jeremy Hunt guy, who was it? The Liz Truss fired the last guy.
Oh, really?
Yeah. Kwasi Kwarteng, I think was his name. Yeah, Liz Truss fired.
Kwasi, is it?
Yeah, it is. Kwasi Kwarteng. I don't know if that's how you pronounce it. I'm probably butchering it, but yeah.
That's funny.
I think she fired him for this new guy, Jeremy Hunt.
Wow.
But anyway, on Monday, the new British Finance Minister, Jeremy Hunt, reversed the majority of the tax cuts introduced by his predecessor, Kwasi Kwarteng, on September 23rd. And Prime Minister Liz Truss apologised for mistakes that had caused severe market turbulence. Questions are now being raised over how long Truss will remain in office.
It's a pretty vital mistake. I mean, that's like economics 101. I mean, it's obviously doing a tax cut is just pure stimulus. So like, I don't know why you would do that in an inflation environment, but not exactly. Yeah,
I was gonna say, did you see the clip of King Charles?
No,
where Liz Truss goes back to King Charles because they only met like a few weeks ago. She's only been in office for a couple of weeks, and King Charles like gives her the handshake. And he goes, she's like, oh, always a pleasure to see you, Your Majesty. And he's like, back so soon, dear, oh dear.
I haven't seen that.
It was pretty funny.
Oh, boy.
Anyway, so I think maybe he's not the biggest Liz Truss fan. But yeah. Anyway.
Yeah, right.
What else? Only thing else to add to this is Bank of England's next monetary policy report comes out on the 3rd of November. So we'll see what they do. But I don't know. Predictions? Do you think they'll lower rates?
Well, who knows? They could do anything. Anything could.
You're a true fence sitter. No, I don't think you get any prizes for guessing what they're going to do.
They're gonna have to jack rates up. They're looking in a very vulnerable position. Their rates are a lot lower, I believe, than the US, and their inflation is higher. So they've got either some catching up to do now, or some real catching up to do later. That's the choice. But yeah, I hope for each country that they don't need to do a Volcker-style interest rate hike. I hope that... Look, I hope the UN's right, in honesty, because if it is just purely supply side and there is remedies for that can happen over the next 6 months, then interest rates don't need to keep going up. That's just the reality of it. So I hope the UN's right, but I'm not super convinced.
All right, let's. Should we finish off with some Q&A? We have been going, Hamish, for 56 minutes, so we've got a couple of minutes left. Do you want to pick one out?
Yeah, I'll.
Let me
ask you. I'll ask you this one.
This is an interesting one.
What's the balance between holding cash and buying stocks at a discounted price? Thanks for the pod, guys. The laid back yet informative style works. Well, thank you, because that's how we enjoy doing it. So
I love that. Love that reinforcement that being laid back is a good thing. All right, I will continue to be laid back. No stress there at all. Geez, this is a good question, isn't it? What's the balance between holding cash and buying stocks at a discounted price? It's tricky because you don't want to be stuck with no cash, because what if the market goes down more? But you don't want to not buy a stock that's on your watch list if it's at a discounted price. So I don't think there's a necessary. Maybe you can answer this better than me, but I don't think there's a hard and fast rule. X amount of cash, 10% of cash, 20% of cash, always, or something like that. I mean, for an investor, you might just want some cash, just as like so you're not all in all the time, so you don't get screwed. But I think here's what I say. I don't think if a stock that's been on your watch list for a long time goes down past whatever margin of safety you're looking for, I would not hesitate to buy it, because I would be, I think I should be in cash, because who knows, the market could go lower and I might be able to get a better deal then. I don't know. That would be my thinking. I would never pass up the opportunity to buy a great business that I've been looking at for a while and it's hit a great price. I wouldn't pass up that opportunity. I would always have an emergency fund of cash. I wouldn't ever go to 0% cash. Yeah. But I don't quite know where those numbers would be for me. I don't know.
So the way I think about it, and Matt Peterson kind of gave me some clarity on this, I think that kind of helps. I think it's a good idea to separate what cash you are setting aside to invest and other cash that you need. Like what you said, in having an emergency fund is necessary, whatever that is for you, 6 months of income or whatever it is set aside. Maybe you have other cash funds for a holiday fund or whatever it is. I think of that separately from the cash that you have set aside to invest. And then when it comes to that cash, Matt Peterson's, what he said to me was, you want to be 100% invested, right? You want all your money that you are setting aside to invest to be working for you at 10, 15% compounding away. The only thing holding you back from that is whether you can find enough opportunities. And that kind of has fluctuated. For me, that's fluctuated over time. There's been years where I haven't found anything and my cash kind of builds up. And there's been periods where I found a lot of investments and I've been pretty much all in terms of the cash I'm setting aside for specifically investing. So that's how I think about it. I think that's how probably a lot of value investors think about it. But yeah, don't think that you want to be 100% invested means put all the money you have in the world into the market. I think that's probably not a good
Michael
strategy.
Saylor. What's his quote like? And if you don't have any money, then mortgage your house and buy Bitcoin.
Yeah, you should be doing everything you can to buy Bitcoin. Mortgage your house, buy Bitcoin.
Oh God!
Sell your mum's house, buy Bitcoin. Like it's just don't do that.
He's in a world of hurt.
I can't believe he said that. I mean, he has to have been joking to some extent. Obviously, he's being like he's been over the top.
Yeah.
But also that clip sounds patently insane. And when people don't know the context of it, like I don't know the context of it, to be honest. I'm just hoping that he wasn't being serious. But like in 10 years, someone's going to find that clip and be like, this guy is an absolute lunatic.
Yeah.
Unless Bitcoin goes up a bunch, then people will be like, this guy's a genius.
I mean, he's suffering right now.
Well, his entire reputation is sitting on Bitcoin doing extremely well, not just okay, extremely well. So
he transitioned his company's balance sheet to Bitcoin. I think he got kicked. Didn't he get kicked out of his company?
He's
taking too many risks.
But yeah.
It's not surprising.
Yeah, I mean, he's kind of gone off the deep end with cryptocurrency. So
1 year return on Bitcoin, negative 65%.
It's not bad.
It's not bad. What are you talking about? Oh yeah, not bad. Yeah, I'll lock it in.
Yeah.
It could be worse. Yeah. I could have held all those NFTs and now worth nothing.
Oh, yeah. Like you could have. Yeah, you could have been in ARK. Ark's
I don't even know.
Pretty close to that, I think. About 60-something%. I don't know.
What's the ticker? ARK with 2 Ks. I don't even know. What is ARK at? Oh yeah, 70% last 12 months. Down 70%.
Yeah.
Oof. Wait, peak from its peak? When was its peak? Oh, it's peak to trough now 77%.
Yeah. So there you go.
There you go. You could have been an ARK. Thank goodness I was in Bitcoin.
Well, it's all relative, right? So that's good then.
Yeah. Anyway, geez. Yeah, carnage. Real carnage. I hadn't looked at that in a while. Anyway, guys, anything else to say on that one, Hamish, or wrap things up?
Anything else to say on cash? Not really. No, I think that's it. Yeah. No,
work hard, earn cash.
Spend it.
Invest,
spend it all.
Spend it on stocks. Enjoy long-term benefits of more cash.
Exactly right.
All right, sweet. Thanks, guys, for listening. We are going to round things out. Of course, if you have a question you'd like to ask us, definitely go over to the YouTube version or the Spotify version of the podcast and either drop us a comment over on YouTube, or there's like some, I still haven't looked on Spotify, there's some box you can ask a question or something.
Scroll down.
Hamish says scroll down. Yep, down you go. Down. There's the box. Click it. Ask questions.
Well, not yet. We haven't finished talking. You can come back up. Come back up.
Still look at our pretty faces. Listen to our pretty voices. All right, that'll do us for today, guys. Send us any questions or any topics you want us to discuss as per usual. And as always, thank you very much for giving us an hour of your time. I will not ramble on because then I'll sap up even more of your time. So thank you, Hamish, for joining. Thanks to Sharesight as always for sponsoring, and we'll see you guys next week.
See ya.